Hello everyone, and welcome to this podcast on Accounting Standards Update 2010-28. When to perform Step 2 of the Goodwill Impairment Test for reporting units with zero or negative carrying amounts, also known as EITF Issue 10A. My name is John McMahon, and I'm a Senior Manager in KPMG's Professional Practice Group. Today, we will be discussing the outcome of EITF Issue 10A, which the FASB issued as ASU 2010-28. This podcast will run for approximately 10 minutes. The objective of this podcast is to explain the background of EITF Issue 10A, the issue that the EITF was aiming to address, and the final consensus reached by the task force. Let's start with a little background. Under Accounting Standards Codification Topic 350, Goodwill is tested for impairment at the reporting unit level using a two-step model. The first step compares the carrying amount of a reporting unit against its fair value. If a reporting unit's fair value is in excess of its carrying amount, then the reporting unit passes Step 1 and there is no need to go to the second step. If, on the other hand, the reporting unit's fair value is below its carrying amount, then the reporting unit fails Step 1 and is required to go to Step 2, where the amount of any impairment charge, if any, is measured. One of two approaches are generally used to perform the Step 1 test, either an equity value-based approach or an enterprise value-based approach. Under the equity value-based approach, the fair value of a reporting unit's equity is compared to its net book value, in other words, to the net of all of the reporting unit's assets and liabilities. The enterprise value-based approach is similar, with the exception that it excludes interest-bearing debt from both the reporting unit's fair value and its carrying amount. This issue was originally brought before the task force because practice had developed that reporting units that had a zero or negative carrying amount would seemingly automatically pass Step 1 of the test, as the fair value of a reporting unit could not be less than zero, even though qualitative factors may exist that indicate that goodwill of the reporting unit is impaired. Some constituents questioned whether it made sense for these reporting units to automatically pass the Step 1 test, given in some cases a negative carrying amount would be a strong indicator of impairment. In addition, the testing approach selected, either an equity value-based or enterprise value-based approach, could impact the result of the Step 1 test, as the example in this slide illustrates. In this example, the reporting unit passes the Step 1 test under the equity value-based approach, as it has a positive $50 fair value compared to a negative $100 carrying amount. However, if we exclude interest-bearing debt from both the fair value and the carrying amount, and note that in this example the debt's fair value is below its carrying amount, then the carrying amount is adjusted to a positive $1,000, which is in excess of the adjusted fair value of $950, and therefore the reporting unit fails the Step 1 test under the enterprise value-based approach. Moving on to the final consensus. Previously, the task force had discussed whether to mandate the equity value-based or enterprise value-based approaches for the Step 1 test, and had concluded that an equity value-based approach should be used, which is what was included in the proposed ASU. Through the comment letter process, there was general support for the objective of the proposed ASU and most of its contents. However, there were diverging views on which approach to use. Some suggested equity, others wanted enterprise, and others supported keeping a choice of either approach. Ultimately, the task force concluded that it would not mandate the use of either approach. Rather, assets and liabilities should be assigned to reporting units based on existing GAAP. Existing GAAP requires that assets and liabilities are assigned to reporting units if two conditions are met. Firstly, the asset will be employed in, or the liability relates to, the operations of the reporting unit, and secondly, the asset or liability will be considered in determining the fair value of the reporting unit. In addition, to address the specific circumstance when a reporting unit has a zero or negative carrying amount, under either approach, the final ASU requires that if those circumstances exist, a Step 2 test is to be performed if it is more likely than not that goodwill is impaired. In considering whether it is more likely than not that a goodwill impairment exists, an entity should evaluate whether adverse qualitative factors exist, including the examples in ASC Topic 350 used to determine whether an interim goodwill impairment test needs to be performed. That is not an exhaustive list, and the focus really is on whether it is more likely than not that goodwill is impaired, rather than the existence of qualitative factors. For multiple reporting unit entities, this will not result in a change to current practice on how to determine which assets and liabilities to allocate to reporting units. As an example, if you allocated corporate debt to reporting units before, you are going to continue to do so, assuming that corporate debt continues to meet both conditions in Topic 350 for assignment. However, we believe there will be a change for single reporting unit entities. Many companies currently follow the conclusions reached at a 2002 EITF Agenda Committee. While the committee report is not GAAP, it stated that single reporting unit entities should assign all assets and liabilities of the entity to its single reporting unit. Given the basis for conclusions section of the final ASU stated that the ASU was not mandating an approach for calculating the carrying amount of a reporting unit for the Step 1 test, even for entities with single reporting units, we believe that this practice will change as companies are not required to assign all liabilities under the enterprise value-based approach. However, the two conditions in Topic 350 regarding the assignment of assets and liabilities still needs to be followed. What is not changing is the requirement that if you factor an asset or liability into account in determining a reporting unit's carrying amount, then you must also include that same asset or liability in the reporting unit's estimated fair value. In other words, you must use an apples-to-apples approach. Finally, on this slide, no additional disclosures were added as a result of this issue. This ASU is effective for public companies for fiscal years beginning after December 15, 2010, and interim periods thereafter. In other words, it is effective January 1, 2011 for calendar year-end companies. Early adoption is prohibited for public companies. Non-public companies have an additional year to adopt. For calendar year-end non-public companies, the effective date is therefore January 1, 2012. However, non-public companies can elect to early adopt at the effective date for public companies. At the date of adoption, entities are required to perform a Step 2 test for any reporting units that have a zero or negative carrying amount and for which it is more likely than not that goodwill is impaired. Any resulting impairment charge upon adoption would be recorded through a cumulative effect adjustment to beginning retained earnings. That concludes this podcast. Thanks everyone and have a great day.